Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these market update live streams. We do this every week. Of course, the market was closed yesterday on Monday for President's Day, so we're doing this Tuesday every week, 9 a.m. Eastern Time. We're going to check out what's happening in the market, where's the market starting at this week, what to watch, some of the stocks I'm watching, and some of the news you need to know. So, love doing these, not only just to do a market update, but interacting with all you out there in the nation and talking back and forth. So again, thank you for being here. What a week it's going to be too, with it looking like the world is marching closer and closer to war. Got a lot of updates as far as the Russia and Ukraine situation, how I think that could develop. And why, maybe you don't need to worry too much about these geopolitical events when they happen in the stock market. We see these as very quick, developing things that in the end don't really affect the market quite as much as we might think. So we're going to get started on that. I do want to invite everyone to check out a free webinar that we've got. Actually, it's a course that I put together with Thomas Carbo on technical analysis. We do a lot of the fundamental analysis and investing here on the channel. But especially times when the market is so volatile like it is now, with stocks up 2%, down 2% in a single day, and bouncing around so much, then it really helps to employ some of this technical analysis that we talk about in this course and in the webinar. We actually put together a free webinar, so you don't have to join the course necessarily. You just click through the link. I'll leave a link in the chat here, as well as in the comments. It's a free webinar. Check that out. It's going to give you the top 3 signals, the trading signals that we look for when to buy stocks, when to sell stocks, some of those technical analysis that you need in every investor's toolbox. So check that out. You don't necessarily need to buy the course. It's a great deal. We've had about 83 students in the course already over the last couple of months. But I'm gonna get you in that free webinar to just as a part of a thank you to the community for being a part of the community. I want to get started though, because we did have the worst week for the Dow Industrials index last week, or the worst day of the year for the Dow Industrial Index. So if you don't know, usually you talk about the stock market, and you're talking about 3 major indexes, right? The Nasdaq, which is mostly tech stocks, very heavy tech stock index. You've got the S&P 500, which, when you hear about the stock market, that's usually what people are talking about, right? The stock market is the S&P 500, is very much more broad-based than these other 2 indexes like the Nasdaq or the Dow. It is still very much heavily focused on tech, because its market cap, it's the 500 largest companies based in the United States, but it is market size weighted. It is company size weighted, right? So it depends on the size of those companies, and tech companies are just a big part of the stock market, right? So it's about 25% in tech stocks there, the S&P 500 and the S&P 500 index, but it is more broadly spread out across those other sectors as well. And then the Dow Industrials, obviously the oldest index we got there, just 30 stocks. Is much more focused on those old, very very old, mature industrials companies, manufacturing companies, things like that. And so what we'll usually see in a stock market sell-off, a crash, things like that, is obviously the Nasdaq does much worse because it is those risky, volatile tech stocks. The S&P will fall a little bit less than the Nasdaq, but then more than the Dow. Because it is also tech-heavy focused as well, but it also has finance, energy, industrials, a lot of those other sectors. The Dow, in turn, usually falls much less because it is much more of those those more mature cash flow companies. Well, what we saw last week is the Dow Industrials actually fell more than the other 2 indexes, and like I said, it had the worst day of the year. In a single day on Friday, and sold off more than typical. And what I think a lot of this is obviously, tensions in Europe with the Ukraine situation, fears that a larger scale war would hurt global economic growth, which of course would hurt a lot of those big industrial companies. But it's also kind of a bad sign for the economy for the stock market, because a lot of times what we'll see in a stock market crash is those expensive stocks, the most expensive stocks that have done so well over the last couple of years and have really ridden the bull market the hardest, those will crash first, right? And then that market weakness and the bad investor sentiment just metastasizes into the rest of the market. And that's when you see the real pain, the real stock market sell-off and the crash happening, is when when that negative investor sentiment just spreads into every stock everywhere. Okay, and of course, we've seen this kind of thing before. That story, that theme, in 2000, it was first the late 99, early 2000. It was the internet stocks, right? With the internet bubble, those sold off, but then that metastasized into even the larger tech stocks, as well as the broader economy, or the broader stock market. In 2008, it was a really good example. In 2008, we actually saw the S&P 500 peak in July of 2007. Okay, so almost a year before the big stock market crash. And first, you saw a lot of the mortgage providers, the housing-related stocks get hit in late 2007, early 2008. A lot of those sold off, but the rest of the market wasn't doing too badly until we actually did start seeing that market, the negative investor sentiment, and the other factors come in and affect financials, and other sectors in the economy, and really that weakness spread to the rest of the economy. So, against that market outlook that could be signaling a deeper stock market correction. Right now, the Nasdaq index is down 15% from its November peak. The S&P 500, so that broader market index, is down about 8%, 8 or 9% from its market peak. So not a stock market crash just yet, although it is a very much a correction. Now, against that, we do see strong economic growth. The economy is still expected to grow 4 to 5% this year in the United States. Last week, we saw stronger than expected consumer spending data. The consumer is still very strong. They have very little credit card debt. A lot of the debt statistics for households have come down, while their savings have come up during the pandemic. This was one of the first recessions we've had in a long time, the first I can remember, where we didn't have a drop in consumer spending. We didn't have a drop in a lot of the economic factors that we usually see with a recession. We didn't see a lot of I'd say the unemployment problems, where it was really temporary. A lot of those came back very quickly. So the economy is still very strong. What that tells me is that we're probably not looking at a full-blown stock market crash, right? The S&P, the valuations on stocks in the S&P 500 have come down very close to their 10-year average. The S&P 500, I believe, on a forward PE basis, forward price to earnings basis, is trading right around 19.5. And if you look back about the last 10 years, the average is right around 17 or 18 on that forward earnings basis. So earnings were about 30% in the fourth quarter, which is the fourth straight quarter of higher than 30% earnings growth. So companies are making money. They're passing on a lot of that inflation to consumers. So profit margins are still good. Corporations have very strong balance sheets. So we just don't see the kind of overvaluation and the kind of market mood that usually gets into that full-blown stock market crash. So with the S&P down 10%, with the Nasdaq down 15%, I think at least half or more of the sell-off is probably already in right now. So I think if we're talking about a strategy for the stock market, I don't think you rush to protect yourself, even with the market looking like it's going to open negative today. And we'll talk about that. We'll look at that pretty soon here. Even with stocks looking like they're going to open negative and probably going to be weak for the rest of this week and next couple of weeks even, I don't think you rush to sell or protect yourself in a lot of these stocks, especially if you're in those growth stocks that are already down 40 and 50 and 60%. Those have already crashed. Why are you selling now and really booking that negative, that crash return, and not going to be able to take advantage of the upside? It doesn't necessarily mean you rush in to buy a bunch of those stocks. I've actually been picking up some of those growth stocks that have fallen 40 and 50%. I've, picked up shares of SoFi, Salesforce.com, CRM there, PayPal, a lot of those Teladoc, a lot of those growth stocks that have sold off so much over the last year. I've actually been picking some of those up, but I don't think you rush in to pick those, pick up a lot of stocks either. I think you just kind of stick with what you have. The new cash that you deposit, you should, even if you're not investing, you should always deposit new cash every single month, just to get it, stay in that habit of investing, depositing your money from your checks and saving your money. So deposit your cash into your investing account, keep it in cash, and wait for the turnaround, because I still believe that March is going to be kind of an inflection point for the markets. We could talk about that, but I think a lot of times you'll see that sell the rumor, buy the news, or buy the rumor, sell the news. And I think that's what we've seen over the last few months. It's really since December is the market has been looking towards these higher interest rates. We knew the Fed was going to start raising rates. It started looking like it was going to come a little bit earlier than expected. So we're now talking about the Fed is definitely going to start raising rates in March, of course. And the market was looking at that, seeing those higher rates, possibly lower economic growth on higher interest rates, and started to sell off early. Investors were saying, hey, it's been a great bull market. I'm going to take my profits before interest rates start going higher and the prospect of slower economic growth and really hit some of these stocks. So that's really what we saw. We saw a sell the rumor scenario. Well, and then when March does finally come around and we get those higher interest rates, there's a very good chance that we have a collective sigh of relief in the market. And we say, okay, you know what? Interest rates are here. Typically, historically, if you look at the data, the stock market is up while the Fed is raising rates. Okay. And you got to look at that larger picture. Why is the Fed raising rates? Because besides inflation is hot. The unemployment rate is very low. Unemployment rate is near a historic low. 3.5% was the historic low. I think it's right around 4% now. So unemployment is very low. People are making money. Wages are going up. The economy is growing. So yeah, the Fed is going to be raising rates to kind of moderate that economic growth and slow inflation. But that's still a good sign for stocks. So stocks generally do increase while the Fed is raising rates. So I think once we get into March, we have a sigh of relief, and okay, interest rates are rising, they're here, but they're not going to kill the economy. Okay. Interest rates actually have to get up to around 4%, 3.5%, 4% before they really start hurting economic growth. Right. And we're a long way there. Rates are about zero now, and the Fed is only expected to raise rates as far as maybe 2%, this year for the rest of this year. So that is far and away from where it would start really hurting the economy. So I think you can see stocks still do well this year, and I think that starts to happen in March. So again, for a stock strategy for this market, I think you hold steady. You see how things develop over the next month, but then you start looking to deploy that cash and really pick up some of these opportunities as we get into March and as we get into that first interest rate hike. I want to talk about some how the market's going to open, how it closed last week. As we mentioned, it was a kind of an interesting idea that the industrials focused Dow did fall more sharply last week than the two indexes. Besides that kind of broadening of weakness, it could also be a sign that maybe the tech stocks have reached more attractive valuations. The Nasdaq, like I said, is down 15% from its peak. And a lot of those growth stocks, a lot of those smaller, newer growth stocks are down 40 and 50%. So you got to kind of wonder, okay, how much further are they going to go down? And are they more attractively valued right now? And is that why the Nasdaq fell less than the Dow Industrials and some of those older stocks? It does look like we're going to open lower today, and Nasdaq futures down 0.4%. S&P futures down only 0.14%, and it has really been a heroic comeback by the futures market. Again, the way trading comes out before the market opens, not necessarily always a good indication of how it's going to open or how the rest of the day is going to go. But if you look at earlier, futures from last night and this morning, they were down as much as 1.5%, 2%. It looked like it was going to be a sell-off, a bloodbath today. And now they're coming back to almost unchanged, right? In fact, the Russell 2000 futures are actually positive for the day. So it's a very positive that the market is kind of trying to look past this, the Ukraine tension and some of that, and look at economic growth and really where that's heading. Gold finally broke out of its 2-year range last week, broke into the $1,900 per ounce, which was really interesting because, even on historic multi-decade highs in inflation, gold was stuck there between $1,750 to around $1,850 an ounce. Really had trouble breaking through that range. It took, the threat of a global world war to really break it out of that range, which I think says something, obviously, for gold that it is already, a little bit expensive here, at in that range, and even at 1,900. That 7% inflation and the threat of a global war only slightly brings it higher into 1900. So, I still do like the gold miners rather than that direct investment in gold. The gold miners at $1,900 an ounce, gold miners are swimming in cash, and they're likely going to be increasing their dividends, while gold itself has proven a little bit more richly valued and having a hard time moving higher, even on that inflation and the risk-off environment. The price of oil cooled a little bit last week. It's up now, of course, obviously on those Ukraine tensions. We did see that I think Germany shut off a major pipeline there from Russia, starting to think about sanctions and stuff there. So obviously gold is up today, crude is up today. But one very important news last week, why crude oil was actually down, is there was talk of some kind of a new nuclear agreement with Iran. Okay, so obviously a few years ago, U.S. pulled out of the nuclear agreement with Iran, saying that they couldn't be trusted. They were enriching uranium anyway, so pulled out of that. Put sanctions on Iranian oil so it couldn't sell its oil into the global market. That's one of the things that has been supporting oil prices higher, besides just general demand and that kind of thing. Now, this all makes sense, right? That the U.S. would come back into those nuclear agreement talks, would try to set something up with Iran. Iran desperately needs those sanctions lifted and to be able to sell its oil on the global market. The rest of the world needs cheaper oil. Oil at $93 a barrel on WTI, on West Texas Intermediate, is extremely high. You're getting to the point where it's going to start sapping economic growth. So the world needs cheap oil. Iran needs those sanctions lifted. So both sides have a reason to negotiate, and a deal could see Iran's barrels come back on the global market and a little bit lower crude prices. So. Oil and oil stocks have been doing really well over the last months, actually, and but there are some headwinds there for further appreciation. Let's look at how the sectors did last week and kind of what I'm looking at. Some very interesting ideas. Just one of the 11 sectors. So this is the Select Sector Spider, the sector tracker there. All you out there in the nation know this is one of my favorite tools to look at, see kind of that bigger picture, how the stocks in each sector are doing. So you go to sectorspider.com if you want to look at that. Go to Tools and then Sector Tracker. And we can come down here. And so over the last 5 days, over last week, just one of the sectors finished higher, and that was consumer staples. Finished 1% higher. Materials actually almost finished higher, just down 0.17%. A trend that we've been seeing in the stocks in the materials sector. So you've got those chemical companies, fertilizer companies, aggregates, construction materials companies, things like that, and miners have been doing really well over the last couple of weeks. I noted this a couple of weeks ago that the material sector valuations, those valuations for stocks were very attractive in that sector. That's about when they started picking up, is over the last couple of weeks. And you can see they did very well compared to the rest of the market last week. So I would still be watching the materials stocks in the materials sector, for some strength. And of course, if we do get some kind of, continuing economic rebound, the infrastructure program heating up, things like that, those stocks in the materials sector will continue to do well. Another interesting point from last week's consumer staples did really well, up 1% against the stock market that was down almost 1.6%. And it really looks like the inflation-related pain for stocks in that sector, in the consumer staples sector, is finally kind of passing. The sector was one of the first to get hit as companies last year like Clorox, like Kraft Heinz, reported their higher costs and really the lack in pricing power to pass those on to consumers. Okay, so consumer staples, these are all the companies that sell those things you really have to buy, right? The personal products, the food, things like that. And the problem here with that higher inflation is these companies are paying higher inflation in their price or in their supplies, the things they put into making their products. But it is so competitive, it's such a competitive market for food, for packaging, for things like that, that it's really hard passing those prices on to consumers, increasing their own prices, because consumers are very price conscious, right? You can buy the Kellogg's corn flakes, but they look pretty much the same as the knockoff brand, right? So if Kellogg's raises the prices on its corn flakes too much, you're just going to buy the knockoff brand. So very competitive in that sector and in those industries. So a lot of those companies were having trouble passing those inflated costs on to consumers, and we saw a lot of the profits fall, close lower, and that was a lot of the weakness in consumer staples over the last year. We're finally seeing that come off, though, right? We're starting to see some pricing power in these stocks. So those are higher. Both companies, actually, Clorox and Kraft Heinz, reported positive strength last year in their earnings. And in fact, 19 of the 32 stocks in that sector did close higher. So it was a very good week for consumer staples. I think they continue to do well. The valuations are attractive in that sector again, as well as just an idea of, protecting yourself from any more stock market sell-offs, right? Obviously, these companies, they sell things you need to buy, so the cash flow is very much more reliable than a lot of these other stocks. So it's going to be a little bit safer, obviously a little bit higher dividend paying stocks in that sector. So I think that's one you watch as well. Let's look at some of the things that I'm watching for this week. We did get kind of conflicting news over the weekend about the Ukraine situation. First it was Putin had agreed in principle to a meeting if he would kind of slow go on, what he was doing on the troop buildup and possible invasion of Ukraine. Then we heard that he formally recognized some of the rebel or breakaway regions in Ukraine, which is an old playbook. Okay, this is not surprising anybody, right? What happens a lot of times, especially Russia. Russia loves to use this trick. China's used it in the past, even the U.S. Most countries use this trick when they've got neighbors that they typically go at it with. And so basically what happens is Russia for decades has incentivized and really incentivized and promoted some kind of a migration of Russians, especially around the border, into Ukraine, right? Try to get Russians and Russian people, or not necessarily people, but Russian influenced people to move into Ukraine and set up shop there, be part of the population. Basically, that means is that eventually, of course, those Russian friendly population in Ukraine can start talking about their own independence, right? And of course that gives Russia or any country that's using this trick. Again, this is the oldest trick in the book and is not fooling anybody. When that Russian friendly population starts talking about their independence, starts talking about how they want to be a different state, a different country from Ukraine, excuse me. It's not the Ukraine, it's Ukraine. But when they talk about their independence and things like that, and the rebel forces, right? That gives Russia an excuse to say, hey, we want to protect these people, right? They're a sovereign state. They're their own independent, breakaway states, and we want to go in to protect them. So we're going to send in a peacekeeping force, right? That's how it always is. And that's what we saw out of Putin and Russia over the weekend is they're going to send in a peacekeeping force to protect these, these independent, sovereign people in this, when, basically it's just a prelude and an excuse to move your troops into another country. For Russia and Ukraine, folks, you've got to understand Russia has always been about, and maybe we're getting a little bit far off topic here, but I love talking about this kind of geopolitical, geographic kind of ideas. And for Russia, it's always been about a warm water port. Okay, if you look at all the ports that Russia has available to its navy, it's all cold. It is all ice locked kind of ports. They're in the north in Siberia and things like that. So it is very difficult for Russia to have any kind of a naval presence globally, or naval defense even. It's not all that Russia wants to be wants to bring back the old Cold War geographies and boundaries and things like that. It is also very much looking at its own defense and that kind of thing. And for that, it needs a naval presence. It needs to be able to defend itself through naval, through its navy. And that's just very difficult, if not impossible, with the cold water ports it has. So it's always looked to the Black Sea, which is that sea right around that borders Ukraine, as possible naval bases and ports, to get its ships out into the Mediterranean, out into the Atlantic, and out from there. And out into the Indian Ocean, that kind of thing. So it is very important for Russia, not necessarily to control Ukraine or to have Ukraine as part of a Russian territory, but just to be friendly enough that it can keep its bases, its naval bases. I think it has one in Sevastopol, and some of those others, that to keep those open and keep that access to the Black Sea. Right. That's why it annexed Crimea a few years ago, but to have that access. Okay, because Ukraine has been getting very much closer to the West, has been trying to get into NATO, the North America alliance there. It's been trying to get into NATO. It's been trying to get into the EU even. And obviously Russia can't have that, right? Because that would close off the access to those ports, to those warm water ports. So that's what Russia is looking at in this situation. It doesn't necessarily want to have Ukraine as a territory, to want to take over and have to manage all that, because just that kind of situation would be a constant headache for any country. But it does need access to those ports and to the Black Sea and things like that. So, I think a lot of this, as we've been talking about, I think a lot of this is just positioning by Putin to be able to negotiate, to be able to tell the West, hey, look, we're serious about Ukraine. We do not want Ukraine moving closer to the West and into those alliances, into those treaties like NATO, like the EU, and shutting off our access to the Black Sea. We won't have it. And this is the alternative if it does, is accepted into some of those organizations. So I think, Russia does not want a full world war. They've been under sanctions for years. They need sanctions lifted. They can't handle more sanctions. So this is just a negotiating ploy, moving into these countries, formally recognizing these breakaway republics in Ukraine, and moving peacekeeping troops in there, to be able to get in a better position to eventually negotiate a withdrawal and favorable terms for that. Now, geopolitical ideas, geopolitical events in general, though, generally don't tend to be long-term factors in the market. Okay, if we look at a lot of geopolitical events, especially even 9/11 here in the United States, obviously huge, tragic loss of life, and that the market opened, when it did open, it actually closed for a few days. When it did open, was down hard. But, if you look at that, by, I think it was like 2 or 3 months beyond that, the market was back up to where it was before that event. You look at even some of the wars, the Gulf War, some of the other outbreaks and conflicts that we've seen over the past, 2 or 3 or 4 decades. Geopolitical events and this kind of thing, even the threat of war, the outbreak of war or conflicts, hasn't really affected the market that much. Okay, you really have to go back to not even Vietnam. You really have to go back to not even Korea. You really have to go back to World War I and World War II, really, to see the stock market really affected long term by a lot of these geopolitical events. So I think what we've been talking about lately, especially last week, is that yes, you will see some weakness in some of these stocks, in the stock market in general, as this kind of develops, but it's going to be very short-lived. And I think you take advantage of some of the sell-off to maybe pick up some better stocks, or pick up some of the stocks you already own, things like that, because it usually doesn't last very long. As far as economic stuff this week, we do have the personal consumption expenditures, the PCE report, which is the third big inflation report. You have the consumer price index, which is CPI, which most people talk about because that's consumer prices. You have the producer price index, the PPI, and then you have this personal consumption expenditures that comes out on Friday. Now, that's the one that actually is watched by the Federal Reserve, their measure of inflation. So the Fed is going to be watching that is probably going to come above expectations because the CPI and the PPI have both reported very hot inflation numbers over the last month. So PCE is probably going to be hot, going to be a big, big show of inflation again. But I think really the market is really so focused on Europe and Ukraine and all that, and we've had so many of these high inflation numbers that it's likely it's not going to be a big market mover this Friday when it comes out, unless it's just supremely high and really moves everybody into the idea that the Fed is definitely going to raise rates by 0.5% in March. Some people are still holding out for a 0.25% rate hike in March. Some are saying 0.5%. I think most of that is already baked into stocks right now. Earnings season is wrapping up pretty much this week, and it's really had little effect on stocks anyway. As we said, stocks post in the S&P 500 posted 30% year-over-year growth in earnings, very strong earnings. Companies are making a lot of money, and profit margins are still good. And the investors just haven't rewarded stocks for beating expectations. And in fact, they've been punishing stocks for that even beat expectations but provide weak guidance. It's what you've seen in a lot of these growth stocks that have sold off 20 and 25% in a single day. You got Facebook, you had DraftKings last week, that one sucked. You had a lot of these PayPal. You had a lot of these stocks that have been doing really well as far as revenue growth, earnings growth, things like that. But they came out and said, hey, we don't know this year. It might be a little bit slower than what we're expected over the last couple of years. Obviously, with pandemic growth, we can't keep that up forever. So we're going to lower our expectations a little bit with that forward guidance for 2022. The market has not been taking that kindly. So I think what you really have to look for in these, especially these growth stocks that have been working so well over the last couple of years, something we've been talking about on the channel over the last month or so, is those quality growth stocks, right? Those growth stocks that do have, positive earnings, right? That are actually making profits already. A lot of these growth stocks, a lot of the growth stocks like maybe Fastly, some of the other companies that aren't positive. These CRISPR Therapeutics is another good example. I mean, they are definitely stocks of the future. They're going to change the way we live in the future. But right now, they're still very new, very underdeveloped companies with negative earnings, right? They're losing money. That's where you've seen the worst of the sell-offs in those stocks. Quality growth stocks, though, things like PayPal, things like Salesforce that have positive earnings, they have strong revenue growth still, and they're very much in value territory right now. So I think you continue to look for those quality growth stocks, those quality names, throughout the rest of the earnings season and over the next couple of months. I want to cover a couple of stocks I'm watching for this week. Some of the earnings still out this week. Iron Mountain, we actually talked about this stock last week in Friday's video on the highest paying dividend REITs, the real estate investment trust. So those real estate stocks, Iron Mountain is a strong stock. It's expected to report earnings of 40 cents a share and on a 1.15 billion in revenue on Thursday. So later on in the week, shares are already down 17% since December and basically flat for about a year. So bringing the stock right back into value territory. I do like Iron Mountain. It's got a strong 5.7, almost 5.8% dividend yield, and it's not a stock that's going to make you rich, but it is a stock that is going to continue to pay out that dividend and give you some price returns as well. The Iron Mountain, most of their revenue still comes from that physical record storage, right? So any kind of paper documents, any kind of physical records that companies need to store. And for any idea, most companies, they store their records for at least 3 to 7 years, any kind of physical documents. And of course, that's done through Iron Mountain. Iron Mountain is almost the de facto, the monopoly in that segment, because it is such a slow growing segment, right? Not a whole lot of physical document storage needs anymore. So a lot of the companies have gotten out of that sector. Iron Mountain still dominates that, that industry. And it's a great cash flow. It's cash flow that the company can then take and pour into growing its digital data centers, into its digital record storage, and things like that. So, it's a slow growth stock, but it's very high dividend and decent value territory right now. Coinbase also reports earnings this week. Coinbase is expected to report earnings Thursday as well. now the drop in crypto prices recently, management had better have good news for the future. Shares are down quite a bit since since the peak last November, right? Shares hit about $430 last year, and are now down less than half of that, $181 a share. And it's not to say that they're in terrifically valued territory right now. I think you can start looking at the stock, but management definitely needs to start talking about some ways to diversify its revenue, grow its revenue beyond just crypto trading. Okay, and there's a couple of different reasons for this. A couple of things I'm watching here is if you look at so Coinbase makes the vast majority of its money still on those trading fees, right? Coinbase has actually one of the highest fees for buying cryptocurrency in the market of any of the platforms, which is why I do most of my direct investing on on BlockFi now because of the fees. But it makes most of its money there. And if you look at how pricing and how commission trading and things like that happened in investments in stocks. You look at, I started investing in 1999 while I was in the Marine Corps, and it was huge news when E-Trade, it was Brown and Company then is what I started on. Brown and Company went to $5 a trade, which was amazing because most of these other companies, most of the other stock trading platforms were still at $15 and $20 just to buy a stock, right? Which for a lowly corporal in the Marine Corps making all of probably about $800 a month back then, you just can't buy a stock if you have to pay $15 or $20 just to do it. So that $5 stock trade at Brown and Company was excellent. They were eventually acquired by E-Trade, so it's an E-Trade account now. But now if you look at it, I mean, anybody charging $5 for a stock trade is out of their mind, right? It started with Robinhood with no fee trading, no fee commissions. Now it's pretty much everyone. E-Trade, Vanguard, most of those stock trading platforms charge you nothing to buy a stock. And I think that's the way that cryptocurrency is going to go. Okay, there's always going to be some kind of gas fees and commissions and things like that, but you're definitely going to see a race to the bottom in cryptocurrency trading fees. So Coinbase needs to diversify into some of these other ideas. And I expect eventually they will start launching these products, launching these services that differentiates its revenue away from just that cryptocurrency trading app. Okay, they're going to get into NFTs soon, I think, and a lot of those. And they really do need to do it because the revenue growth from cryptocurrency trading is probably something that isn't going to last very much longer. So I do think they are expected to report on Thursday. We could check out the price to sales. That's really where I start to look at these growth stocks is anything under a 10 times on a price to sales as well as their growth. Now Coinbase is trading for 6.8 times on a price to sales basis. Which is decent value if it can continue to grow its revenue by quarterly revenue growth of 300%. In the last quarter, it is expected to continue to grow that revenue. If we'll look at what they're expected to do as far as revenue growth this year. Revenue growth is expected at 7.3 billion this year, then to actually down to 7.1 billion in the current fiscal year. So revenue growth just isn't there for Coinbase anymore. They really do need to start announcing these other initiatives, these other products and other services that is going to boost that revenue. Until then, it's really hard to see this stock go much higher. And if they don't have some good news this Thursday for those other products and other services, we could see the stock get hit from there as well. Berkshire Hathaway reports on Saturday, as it always does, kind of the unofficial close to earnings season when Berkshire Hathaway reports its earnings on a Saturday. Warren Buffett and the vice chair Munger have been especially vocal lately. You've seen him appearing in interviews and the media all over the place, and it's really no doubt they're happy that value stocks have come back in favor. Okay, over the last really even 10 years, if you look at the performance of Berkshire Hathaway versus the Nasdaq versus even the S&P 500, which has higher tech stocks in that index. It's really underperformed. Warren Buffett is a great investor. He's beaten the market index over the last decades, but over the last decade, growth stocks have really been where it's at and have really kind of left Berkshire Hathaway in the dust. If you look at over the last 10-year performance. Now, just this year, so far this year, especially energy, financials, a lot of those value stocks, those have come back in favor, though they are outperforming some of these other investing styles like growth. So Buffett and Munger are going to be in the media talking that up and talking about that. It will be interesting to see kind of how they talk about their portfolio performance versus the index. Buffett did sell out of a lot of his bank stocks last year just before the jump in interest rates. So I think he missed out on a lot of the upside in those bank stocks. So it's going to be interesting to see how he talks about that and what he says. Now I want to talk about let's talk about a few news items in the market. One, we'll come back here. Oh, well, so let's talk about cryptocurrency, because I know we had that we had the question about that earlier. I just want to give you some more ideas, some thoughts, longer term really viewpoint on cryptocurrency. Here we're starting to see a lot of the skeptics, a lot of the deniers actually come around to, if not cryptocurrency, then even even a little bit more related themes in financials, in decentralized finance, blockchain, things like that. And one of them, Warren Buffett himself has called Bitcoin rat poison in the past. And we just find out that he invested $1 billion over the last 3 months in a crypto-friendly bank, right? Warren Buffett invested $1 billion into a bank called New Invest, right? It's really, allows investors to put money into an ETF. It does, or it's called Nubank, right? It's a digital bank based in Brazil, one of the largest in Latin America as far as those crypto trading banks. Has a lot of revenue from crypto trading. Also does some other NFT stuff, as well as some other related ideas. And yes, it is mostly a financial institution. So you could argue that he's really not saying invest in Bitcoin. He's saying investing in these crypto financial institutions. But it's a very fine line there, right? If he's saying Bitcoin is rat poison and has no value at all, then this bank would cease to exist, right? If Bitcoin went to zero, if cryptocurrencies went to zero, this bank would cease to exist, because that's its whole competitive advantage, its whole reason for competing against these old world institutions, is being able to offer those crypto services and things like that, especially across Latin America. So kind of reminds me a lot of what JP Morgan, Jamie Dimon, so CEO of JP Morgan, one of the largest old school banks in the world. He has been a crypto skeptic from day one. Okay, saying things like it's worthless, it's going to zero, over 5, 6, 7 years, in fact. But he's not so much a skeptic that he won't not make money from it. JP Morgan is pushing its high net worth clients, its wealthy clients, into crypto trading services, into crypto investing funds. So it's a little bit like, do what they do, not what they say, because a lot of these crypto skeptics, while they still, they still say that crypto is overvalued or even has no value at all, they're still investing their own money or their clients' money in these products and services. So you got to kind of wonder about what they're really doing as opposed to what they're saying they do in the media. Another idea, and this is really going to kind of my long-term thesis for cryptocurrency and why I invest so heavily in Bitcoin, Ethereum, and some of these other coins. We got news out last week that Colorado is now going to accept, or wants to accept, they have some legislation in the works to accept cryptocurrency for tax payments this summer, right? We also found out that 2 legislators in California actually have a bill up in front of the California Congress to make cryptocurrency legal tender, right? Much like El Salvador did and that. Now, of course, that's nonsense. That's never going to happen, because the Constitution specifically forbids any state from creating its own legal tender, or recognizing anything other than gold or silver as, legal tender apart from the U.S. dollar. So that's just kind of, political grandstanding, and is never going to happen. But the fact that we're seeing things like this, state houses pushing for acceptance of crypto for tax payments, for other payments, we're seeing state houses pushing for these kinds of ideas, tells me that there is enough. There is enough push and enough proponents for cryptocurrency, especially even at the governmental level, that the larger federal government, they can't kill cryptocurrency. Okay, a lot of people are worried that the SEC, Gensler, and the administration, they're going to come in with rules that basically kill Bitcoin, kill cryptocurrency, make it illegal, things like that. And it's just not going to happen. There are 220 million people globally that own cryptocurrency. In the U.S. alone, it is about 16 to 17% of the population. So, and that's roughly, I want to say roughly 60 million people in the United States alone that own cryptocurrency. It is very high, very widely held, in the minority demographics, right? So, doing anything that would kill cryptocurrency or significantly drive down its price is going to lose you a lot of votes. It is very politically difficult to come out against cryptocurrency when so many people favor it, and so many people are pushing for it, right? So that's the reason why I don't think the federal government can kill or even wants to kill cryptocurrency. Obviously, there's regulation coming, something that the crypto industry needs. Cryptocurrencies need regulation to be able to give institutional investors, those big money managers and pension fund managers, things like that need regulation to give them the confidence to invest their clients' money in that. And that's really where you're going to see the next big leg up in cryptocurrency and Bitcoin and Ethereum prices, is when that regulation does come through and does get settled. Another piece of news we saw out last week from the Journal, Wall Street Journal. This one was kind of interesting. The Justice Department is actually investigating spoofing and scalping among short sellers. Carson Block, so a big short seller there, as well as Andrew Left, actually got subpoenas and were investigated. I think one of them, and Carson Block actually had his stuff raided, got a couple of computers taken away, and had a search warrant served by the FBI in October, as far back as October, taking some computers and some other things to really see if these guys are trying to manipulate the market with their short selling. So obviously, good news for a lot of the meme stock crowd, the GameStop and things like that, and some of these other heavily shorted companies that you weren't just crazy talking about the short sellers. They may have actually been manipulating the market. So the SEC and the FBI is actually looking into that, probably coming down on some of those short sellers over the next year, if they do find that they did some kind of a manipulative trading or anything like that. We talked about this a little bit more in the newsletter last night that came out. One thing a lot of times they'll do is they'll put in fake news or fake orders, fake sell orders for a stock just under where the stock price is. So if stock's trading for maybe $10.03, they'll put in a massive amount of sell orders for $10 even. With the rest of the market, anyone else trying to sell their stock, they have to meet that price, right? Or they're not going to be able to sell their stock. So everybody else brings their price down, and just before that price gets executed at $10, then the short seller will cancel that bid, right? They'll cancel that sell order, and of course, take advantage of the fact that they've driven the price down even 3 cents, because if you come back in and buy at $10 and it goes back up to 10.03, 3 cents off of that, and you do that over millions and millions of shares, then you can make some really good money. It's called spoofing. And it's totally illegal to do. And that's one of the things that the FBI and the SEC is investigating, is if these short sellers did those kinds of market practices. I want to do some, just kind of a strategy for the market, for this stock market, and then we'll get into some question and answer before we wrap it up today. Again, what I'm thinking is, it is probably too late for protection if you haven't already protected your portfolio, right? We have talked about in the past how you always want a little bit of a cash cushion, in your portfolio, especially when stocks do get a little bit overvalued, when you start seeing some of these maybe into the interest rate cycle. We were talking about last year with the definite coming of a higher rate cycle by the Fed. You wanted to have maybe a little bit even more cash in your portfolio, waiting for that sell-off. Usually I like to keep at least 5 to 10% in cash and bonds, and some of those other cash-like investments. But now, if you haven't done that, I think it's a little late, because now basically you would be selling out of stocks that are down, and you'd basically be trying to guess when the market is coming back up, and we're trying to guess when to come back into the market. Nasdaq is down 15% already. A lot of those growth stocks are already down more than 50%. So those are already in very much value territory, something that you don't want to lock in. You don't want to sell those stocks, right? It's just a lesson we all have to learn. Okay, we all have to learn that lesson of not being 100% invested in stocks all the time. Okay, you have to have some cash, you have to have some bonds, you have to have other assets like real estate, like even cryptocurrency, some of these other alternative assets we talk about, so that when stocks do fall, you can take advantage of that and sell, take some of your cash or sell some of your bonds or some of your real estate that have done better, and put that money into those cheaper prices. But right now, I don't think, I think the opportunity for that is over, because stocks have already come down so much. We're still seeing very good economic growth. So I don't see, a 15% slide in the Nasdaq becoming much more, much more than maybe we get 20%. Maybe we actually do hit that bear market definition for the Nasdaq, but we're not going to see 25 or 30 or 35% sell off. So right now, if you were selling stocks, trying to position for a bigger sell off, for a bigger crash, basically you would just be locking in most of your loss, and you would have to guess, when to get back in the market. And that's the problem that hits a lot of people, is they sell. The stocks start falling, and they sell at a loss on a lot of those stocks. And then they're gun shy. They wait another year or 2 years even to get back in the market when stocks have already started coming up. So it's basically just keep your money in there at this point. I would keep investing, keep depositing money into your investing account, because that cash is going to build up, and that's going to give you the opportunity to take advantage of those stock prices, right? Especially, I think, as we get into March, as we get into that first Fed rate hike, I think we do see that collective sigh of relief that the rate hikes are here, but they're not hurting the economy. The economy is still growing, and that's when you get that inflection point of stocks moving higher. So I think you want that cash. You keep on depositing cash into your investments or into your investing accounts, hold it in cash until the market does start to inflect higher, and you can start buying those stocks that you really like. And not only this, but it just helps to have that formalized strategy. This is something we've talked about a lot on the channel before. Having that formalized strategy of, okay, you've got so much cash, you're not buying anything until some point. Basically, you're looking at the Nasdaq or your individual stocks or the S&P 500, and you're saying you're formalizing, writing it down. Okay, if the Nasdaq falls another 5% to this point, that's when I'm gonna use half of the cash I have saved and buy more stocks. If it falls further to this point, I'm gonna use the rest of my cash to buy more stocks, right? If it starts going up, then what are you going to do at different markers? What are you going to do at different points in the indexes or in your specific stocks? The reason why this is so important is that it keeps you from worrying every single day what to do about the market, because you've already got that formalized strategy. You know what you're going to do when the market hits a certain points, and you don't have to worry about it. Okay, because the biggest problem with investors is, they worry that they're not fully invested. They worry about that stocks are going to fall more. They never know what they want to do, what they're going to do, and they end up just jumping into bad trades, right? Without that kind of formalized strategy, knowing exactly what you want to do, when you want to do it, at what point in the index you want to do it, then basically you're gonna be clicking to the stock market or your investing account 10 times a day, looking at it, and eventually you're gonna say, okay, you know what, the stress is too much. I'm making the trade, right? And that kind of investing, that kind of knee-jerk reaction investing is never good. It never makes you money. So you really do need this kind of formalized written strategy of what you're going to do, when you're going to start investing some of your cash, when maybe you're going to take even, as the market goes up and hits those new highs, where you're going to take profits in those stocks and in those, in the market. Having that formalized strategy will save you a lot of heartache, and it'll make you a better investor. So now I want to turn it over into some Q&A. We still have a few more minutes left in the live stream. I want to check out what we're doing here. I'm going to scroll up and see what else we have for questions. If I don't see your question, please go ahead and ask it in the chat there, and and use a question mark so I know that it is a question. I'm going to go up here. So Tim M wants to know about gold. Talked about gold there in the live stream a little bit earlier on. Don't know if you saw that, but yeah, the fact that gold couldn't break out of that range for years, 2 years plus, it was stuck in that range from 1750 to 1850, decade high, 7% inflation, couldn't break gold out of that price range. It took almost a global, it took threats of a world war to be able to break it up into 1900. Tells me that gold is not going to make you rich. Gold is it might protect your money, right? If the stock market just totally crashes, then gold is going to stay where it's at, maybe go up a little bit, but it's not going to go up very, very significantly. Gold is already pretty heavily priced right here at $1,900 an ounce. If we do get any kind of a de-escalation of in Ukraine, that kind of idea, if inflation just moderates even a little bit, you're going to see gold come back down into that 1750 per ounce range. So, I don't think you invest directly in gold. I do like the gold miners because, again, they are just swimming in cash flow right now with gold prices at this point. Most gold miners have a all-in sustaining cost, so the total production costs they have for producing that gold right around, $1,200, $1,300, $1,400 at the most, $1,400 per ounce. So with gold at, $1,750, $1,900 an ounce, they are swimming in cash. They're putting it back into, as dividends and that kind of thing. So that's what I would do about gold. Michael Bell wants to know, do I worry about devaluing the dollar? That's my one worry about dividend reinvesting. Now, a couple things there. As far as dividend reinvesting, I don't know that you would really need to worry about the devaluation in the dollar with that because, if you're reinvesting your dividends into those stocks, you've got that investment in the stock, not necessarily in the value of the dollar. Right now, of course, if it's a dollar company, if it's a company based in the U.S. and dollar denominated, then you're going to get some kind of devaluation from the dollar. But I wouldn't necessarily tie that in with the dollar devaluation with reinvesting in dividends. I would still reinvest my dividends into those dividend-paying stocks. As far as a devaluation of the dollar, people have been talking about the dollar is, going to zero, is going to crash. Peter Schiff, we talked about earlier, he's one of the biggest ones that says the dollar is, going to crash, and he's been saying it for years. And the problem is, the dollar is still the reserve currency. As much as I'm a believer in Bitcoin and cryptocurrencies, the dollar is still the de facto global reserve currency. It's still held by central banks all over the world. Obviously we are seeing some devaluation now with inflation around 7%. So basically we're devaluing the dollar by 7% a year with debt so high, just not just federal government debt, but corporate debt, all the debt that everybody owes is going to be very hard to raise those interest rates and kill inflation, down to the level we saw over the last few years. So we are going to see higher inflation over the next couple of years. That is going to be devaluing to the dollar. But you got to look at it in terms of other currencies as well. Again, I think the emerging markets are going to get hit even harder by inflation over the next couple of years. So and as well as Europe and Japan even. So I don't think you're going to see the dollar devalue that much. It's certainly not a crash against a lot of the other major currencies. If you're worried about it though, then, and it is an effect, maybe 1%, 2%, right, a year. If you are worried about it though, you just find other assets. You still have your money in stocks, but you find other assets, and frankly, you need those other assets anyway, like we talked about, to have that anti-stock crash insurance, right? You need real estate, which is going to do well when the dollar devalues, because that real estate's still worth what it's worth. It's still worth the same amount. If the dollar falls in value, then that real estate picks up. So you need real estate. You need other alternative investments. We've been talking about wine investing lately. I've been getting into that because it's it's so much fun just to to learn about the different regions and the different years and vintners and things like that. So that those alternative investments like wine, like art, like collectibles, those do well when the dollar devalues. Cryptocurrency, obviously, obviously cryptocurrency isn't a perfect inflation hedge. It's not a perfect dollar devaluing hedge, right? That's a part of the factor in the investment. It's much more, it's so new the asset class is so new that it's much more just a risky asset right now. So you're going to see that huge volatility, and it's going to move along with stocks. But it is still, in some respects, a hedge against inflation and against dollar devaluation. So I think that's just another reason why, most investors, all investors, should have at least a small portion of their portfolio in, those kinds of things like cryptocurrency. What else? Quincy wants to know about, are developed markets worth owning? Great question. Something we talked about earlier with emerging markets, and where I'm not a big believer in emerging market stocks really anymore. But are developed stocks worth owning? And I do like developed markets a little bit more, mostly just for the diversification you get from U.S. stocks. Okay, it's not sexy, it's not going to make you rich, but if you do have maybe 5 or 10% of your money in a developed market stock ETF, a fund, then it's going to help smooth out these big stock market crashes we get in the United States, right? Developed market stocks, so Europe, Japan, Asia, some of the other Asian stocks, Australia, they have underperformed U.S. stocks, so they are in good value territory. They pay higher dividends typically than the U.S. indexes. But they're not, they're generally not going to make you rich. They're not going to just blow the doors off on returns, but they do help smooth out that risk and that stress from a U.S. stock market crash. So again, I would say, 5-10% of your overall portfolio, maybe in one of these developed market funds. So I know Vanguard, again, has some great developed market funds. I want to say one is like the VMI, maybe, and let's check that out, see if I can show you an actual fund. Let's go developed markets. Okay, the VEA, that's the one I was thinking of. So the Vanguard FTSE Developed Markets Index ETF, that's ticker VEA. Strong, solid developed markets fund, only charges 0.05% expense ratio. So next to nothing, basically nil for the expense ratio, pays out a yield of 2.5%, and it's going to follow those developed market stocks. You can always look to holdings here to see what's in a stock, what's in a fund. So pretty well diversified as far as sector. And you scroll down here and you see, well, it doesn't give us country holdings. But you can see that, and you can always go to the homepage for an ETF. If we go to Vanguard Developed Markets Index, let's try this because I want to show you how to do this. Vanguard Developed Markets. There we go. So if you ever want to see what a fund is holding, and this is not only a good idea just to see what exposure you get with a fund, what it's going to give you, but also a great way to get your own ideas. So if we go here to the fund website, right, and we can go over here to portfolio and management, and so you can see here it's got 53% of the stocks in its fund in Europe, 35% in Pacific, so Asia, right? So you can have Japan, Korea, South Korea. You can have Australia in there. Very small allocation to the Middle East, North America, which developed markets would be, probably Canada as well as the U.S. They're 9.8%. And you can look and you can see, what are the top 10 holdings. Usually they'll show you. They'll have a whole. Okay, so here you can click on portfolio holdings and it'll download, an Excel file or something with all the holdings in the fund. And so again, not only a great way to see what kind of exposure you get from a fund, from an ETF, but also a way to mine some of these, right? So if I'm interested in, developed market stocks, but I don't necessarily want to do a whole ETF, I want to pick my own individual stocks, then I can go here, go to the VEA. Okay, so it's a developed markets. It's that theme. It's going to show me stocks in the developed markets, and I can see what they're investing in. So I can see, okay, Nestle, Samsung, Toyota, and so I can get some ideas of, okay, stocks based in other countries and developed markets that might, I might want to check out if I want to invest in individual stocks. So great question there. I do like developed markets a little bit better, well, quite a bit more better than emerging markets, but still as a relatively small part of my portfolio anyway. World Citizen says Ukraine's annual GDP is equal to 16 weeks of Walmart income. That is interesting to say the least. If you're saying that it's something like it wouldn't matter, it's insignificant, I guess, as far as global GDP and global money. I think you probably got a point there. I don't think Nobody wants to go to war over the Ukraine, right? Honestly, we've already seen that the world pretty much stood by as Russia annexed the Crimea. You put sanctions on Russia, but they weren't real heavy biting sanctions. So the world definitely doesn't want to go to war, but it does need to make a stand. And I think it will make a stand with this. If this escalates anymore, there's going to be further sanctions on Russia that it might not be able to live through economically. But again, I think a lot of this is Putin is just negotiating. He's positioning. He's saying, okay, I'm not bluffing. We cannot have Ukraine move further to the west, in some of these strategic alliances like NATO, because we need access to these warm water ports in the Black Sea, and we won't have Ukraine as part of NATO or some of these alliances. So it's a line in the sand that Putin is drawing, and the West is pretty much going to have to negotiate from. So again, obviously things are escalating a little bit, but it's not going to. I do not see this turning into a global war because neither side wants that. Russia just wants assurances. The West just wants status quo, just wants where it was. And honestly, I mean, when it comes down to it, I don't think Europe would fight for Ukraine's admission into these alliances, right? Europe is fine with Ukraine being closer to the West, close to NATO, that kind of thing. But it's not going to let Ukraine into NATO if it means war with Russia. It's not going to happen. So that's where we're at as far as the negotiating there. Jonathan wants to know: are you dollar cost averaging as stocks drop? Great question. I know a lot of investors have been talking about this dollar cost averaging. Basically, as your stocks come down, you buy more shares. So if you bought a stock at $100 a share, now it's at 50. Sucks because you lost 50% of your investment. But if you still like the company, if you still like that long-term investment thesis and you believe it can go up higher, you buy more at 50. Now your cost basis is only $75. Now it only needs to come up, instead of doubling now, because, if your price was 100, if it's now at 50, that stock needs to double 100% to $100 a share for you to start making money again. Well, now if your price is $75 now, that average cost between those two prices, then it doesn't need to come up quite as much. It only needs to come up 50%, right? From 50 to 75, 50% it needs to come up. And so I don't generally tend to dollar cost average just because stocks drop though. I dollar cost average into my stocks. I don't own that many stocks. I only own, I own more than I should, maybe about 30 to 50 stocks, I think. I have to check. But I just invest regularly in those same stocks. So every month, every 2 or 3 months, I keep putting money in the account, and then I'll allocate that to the different stocks I like. Now, I have picked up some of these stocks that have sold off dramatically, like Fastly. I bought more shares of Fastly last week after the big drop. I bought more shares of PayPal recently, of Salesforce. Salesforce.com, of CRM. I bought shares of SoFi. I didn't own that one before, but I do own that now after the big drop recently. So I am buying some of these growth stocks selectively. I'm not dollar cost averaging all of my stocks just yet, because I do want to hold some cash, on the side for that. Forest King wants to know about DWAC. DWAC is the SPAC, right? The SPAC that is going to take public, Donald Trump's Truth Social, right? The social media platform. I think it's up big in the pre-market, or was up big in the pre-market. So it's probably having a good day today. That's DWAC, Digital World Acquisition Corporation. It's up 5% today, but the thing is with this, there's a couple things. One is, if you look at this, it's the ups and downs have been pretty dramatic. It's went up pretty strongly there to $94 a share just after they announced, and it's and then it came down to $40 a share. So basically, it halved. It lost 50% of its value very quickly after that. It's since built back up to about $90 a share. And I think this is a lot of one of the kind of meme stocks, has a lot of support from a lot of people, and that's great. The thing is, one, I hate SPAC stocks. Okay, this is one thing that I was talking about over the last year or two, these SPAC stocks, they buy these companies, and about 20% of the money, the funding that goes into that company goes directly to the person that set this up, the whoever owns this Digital World Acquisition Corporation. Okay, the sponsor. Okay, they get a huge premium on those, so it's really a horrible deal for investors. A lot of times, the company they buy isn't necessarily at the valuation they're buying it for, right? So it's like a extremely overvalued stock when it starts trading. So there is definitely some things, not necessarily just to do with this Digital World Acquisition or the Truth Social, that I don't like. There's that things. There's also a problem with a new social media platform. Obviously, former President Trump has a big following. He will be able to push this social media network, but he already had a website. He already had, we had Parler earlier, which was kind of a right-leaning alternative to Twitter or Facebook, and none of these did well. Okay, he shut down his website a couple of months ago. Wasn't able to keep that going. So it's going to be very hard to compete. It's going to be very hard for this website, for this social media network, to be competitive and to do well, I think, especially on the valuation that it's going to fetch, when those shares trade, or even on this DWAC, right? This is right now a $3.3 billion market cap company. So I think you really got to worry about, not only on the valuation side, but Trump is actually facing a lot, and I don't want to get political here. I'm just saying the facts. Okay, Trump is facing a lot of legal challenges, and I actually saw a news article over the weekend from a lawyer that actually worked with Trump and represented Trump. So he's not like a never Trumper. He's not somebody that has been against Trump from day one. He actually worked with Trump, but that lawyer said that an indictment is coming. He is going to be indicted in New York for some of these tax fraud claims by the Attorney General. And you can say it's political or not. You can say what you want about it, but they have the evidence to indict him and some of his family for those tax fraud ideas. Okay, evidently he was inflating the value of his real estate holdings to get loans on those, and then he was saying it was worth less. He was deflating what he reported to the IRS for taxes. So, either one of those is a crime. Is a crime to lie on loan applications or to lie to the IRS. So the consensus is that he will be indicted. Whether he ever goes to jail or what that actually does is something else. But if you're depending on him to hold up this social media network, to really drive traffic and revenue and growth for this social media network, it might be kind of difficult for him to do, during those periods or in the future, right? So, I am not investing in DWAC or in the, when it makes that acquisition. I think it's a very risky bet. It's worked out for some investors, obviously, here, but it is very volatile, and it's very hard to move on from that valuation and the outlook for the company. What other questions do we have here? Got a couple other DWAC questions, meaning put in by not necessary. What else? Do you have a link? You put that chat, take me to the course that you put together. So Intermediate Handyman wants to know about the technical analysis course that I put together with Thomas Carvo. Great course, not only for if you want to be stock trading. It doesn't necessarily mean you have to stock trade. I don't stock trade myself, but I like using technical analysis just for buy points, right? Stocks trending signals of when to buy a stock and when to sell, those technical signals that can actually add to your returns. So great question. I actually have in the chat is a link to the webinar in the description to the video. In the description below, you click through that and you can actually find a link directly to the course to see what's in that. It's actually more than 4 hours of video courses, lots of extra bonus material in there, and it's so huge. It's discounted down $150 from the normal price. We just launched it a couple of months ago, so it's still at that launch price there. So check that out in the description below. Okay, what is better? So Ghost L wants to know, what is better, an energy ETF, so a fund that covers energy stocks, or a major oil company? I think they're both. The thing is, and it's probably disappointing to hear both, but this is a part of a larger investing strategy that I use, okay, called the core satellite strategy. Okay, all you out there in the nation have heard me talk about this before. Basically, what you do, you invest in, 5, maybe even more, maybe 5 to 7 ETFs with about 50% of your money or more, 50, 60% of your money. ETFs, funds that cover some of these things, that cover the stock market, cover bonds, cover large assets, but also into these specific funds, right? So if you really like energy stocks, you really think they can do well, and I think they can continue to do well. I've sold some calls against some of my energy stocks right now because I think oil prices are a little high right now, and those could come down in the near term. But you're going to see a lot of really strong dividends from energy stocks. So I still like the sector. So what I can do is I can put some of that 50 or 60% of my money that's going to be in funds, that's going to be in ETFs, into that energy ETF, which is basically, like the XLE, which would be those energy stocks in the S&P 500, right? I can do that. And then, with the rest of my portfolio in that core satellite strategy, then that, 35, 40% of my portfolio, then I invest in individual stocks that I really like, the upside, the long-term return, even more than that sector idea or the bigger picture idea. And that's where you pick those major, the oil companies, the individual stocks, right? All you out there know that, I love Chevron. I think Chevron is probably the single best energy stock out there. We've held it in the Bowtie Nation portfolio several times. I'm probably going to be adding it, if it comes down a little bit more. I own it in my own portfolio as well. Great energy company, very low cost of production for them. Some of the other ones, I know Total and BP are also very low cost production ones, and that's usually what I look for in oil companies or oil stocks is that cost of production versus the price. Some of them, like Exxon, much higher cost of production, so the profit margin isn't quite there, especially when energy prices come down. Okay, Kyle in PA, would you consider McDonald's a consumer staple or consumer discretionary? That's a great question. I haven't thought about it really, because they do sell food. Actually, I think the restaurants, the quick service restaurants, are actually in the consumer discretionary sector or industry. We can actually look. If you're ever wondering what stocks are in a sector, you can go back here to this select sector spider, the sector tracker, and you can look at some of these sectors and click through them, and you can see what's in there. And I do believe McDonald's is in the consumer discretionary sector because it is food, but not necessarily the food you have to buy, right? And in fact, I love McDonald's breakfast. The wife and I were just talking about, because we don't have good McDonald's breakfast down here in Columbia. We have McDonald's, they sell breakfast, but it's just not the same. So we were really missing those McDonald's big breakfasts, the pancakes and sausage and everything. So love it. Wouldn't necessarily recommend it all the time. So it's not necessarily a consumer staples kind of thing. But yeah, consumer discretionaries. You do have, so you see Yum Brands here, which is other quick service restaurants, Domino's. So I imagine you get here and McDonald's is in here somewhere. Starbucks is in there. So you get a lot of these quick service fast food restaurants are in the consumer staples industry. And there we go. McDonald's Corporation is 5% of the consumer discretionary sector, down, over the last 5 days, down 1.8%. But definitely consumer discretionary because, not something that you need to be buying. Melanie says support the channels, press the like button. I appreciate that. Melanie's a long time citizen of the Bowtie Nation. She's actually part of the private Facebook group as well. So thank you for that, for being there. What else do we have? A lot of chat about Russia back and forth. I love that. I love seeing the chat back and forth amongst everybody. Really that sense of community and talking back and forth about stocks, whether it's in the comments to the videos or the Facebook group or anything. Billy Marion, Devil Dog, hoorah, brother. $900 to spend. Should I buy all Palantir or a third? I feel like it was close to the bottom. Okay, great question. A couple different ideas here. I would never buy all, I don't know. It's hard to say because I don't know what else is in your portfolio. You say you have $900 to spend. If you've already got a lot of other stocks in your portfolio and you want to buy Palantir, then yeah, you can buy Palantir. I would say, I've talked about Palantir in the past here. I'm not a big fan at this point. I do think it is a great company. definitely a company of the future, but it is still so expensive right now. We talked about it. It came down, on its earnings report because it is so expensive, and it is one of those stocks that, it is not the quality growth stocks that we talked about, right? It is still very much, a negative earnings, I think, with Palantir. Well, I'd have to check, but it's still very expensive. And they did provide that weak guidance for 2022 revenues and growth. So it did come down hard on its earnings. I think it's still a little bit expensive even now, and if you do continue to see that sell-off, then I think it could come down more. I do like the idea though of putting a third of it in, right? If you don't have any exposure to Palantir yet and you want to buy a little bit, if you think it's close to the bottom, then hey, put in a third, maybe even put in half of that 900. If you already have a lot of other stocks, a lot of other stuff, then yeah, put $400 of it in Palantir. The thing I would say with that is if you don't have a lot of other stocks and a lot of stuff, if this is your whole portfolio, you just now have that $900, and Urab Marine, I know how it is. $900 may be all you have. Like I said, I was first started investing back in 1999. Even as a corporal, I was making all of $800 a month, which sucks. But but you serve because you're proud. But if you've only got that $900, that whole portfolio, then you definitely don't want it in one stock. You want it in at least 5 or 10 stocks to start out with, some funds, some ETFs as well. So if you don't have anything else, then definitely not all in Palantir. I'd put maybe even a fifth of it, maybe $200 in Palantir, and then spread the rest of it out into some funds, some other stocks, things like that. If you already have a lot of portfolio, then yeah, you can put a little bit more into one stock, into Palantir. And the AT&T is undervalued, but there are lots of red flags, fundamentals of business, debt management, free. Okay, so DL wants to know about AT&T stock. YouTube stock analyst, I'd say on YouTube. Okay, and this is something that we do need to talk about eventually, sometime. That YouTube stock analysts aren't really stock analysts, folks. Okay, honestly, even myself included. I spent a lot of time as a legitimate stock analyst, working for venture capital, working private wealth management, working as a stock analyst. And right now, with the level of work I do to produce these videos and this research and everything, I would say probably, maybe a third of my time is actually spent analyzing stocks. Okay, that's how much work it is to create videos, edit videos, do all the other stuff that goes into this entertainment business. Okay, so anytime you see a stock analyst or a YouTube channel or anything like that, you really gotta be skeptical. Okay, because a lot of these people, they have absolutely no experience, no professional experience, analyzing stocks. It's not, maybe they've got enough time looking at the stock market and things like that they know somewhat of what they're doing. But you do need to be skeptical about what they're saying, because I guarantee you they are spending more of their time trying to be dramatic, trying to be entertaining, trying to produce videos and things like that than they actually are analyzing stocks. So just a little bit of rant there. Anytime I see YouTube stock analyst, okay, and that includes me. All right, again, I am much more of a content producer and community leader, I guess, maybe than I analyze stocks anymore. I do still spend upwards of 25 hours a week analyzing stocks. But again, I'm working 50, 60, 70 hours a week total. So it's still only maybe about a third of the time actually doing that research into stocks and things like that. But anyway, I am one of the people that think that AT&T is undervalued. I got about $15,000 of my own money in AT&T. Yes, they do have debt problems. They do have, revenue growth problems, things like that. But those are all things that they've had, over the past couple of years. That's the reason why the shares are down, 30, 40% over the last couple of years. Okay. And something I've talked about back in 2018, I warned people that AT&T, that dividend was unsustainable. That stock price was unsustainable because of how they've been running the company, acquiring those companies, like DirecTV, like Time Warner, paying tens of billions of dollars for those companies and just paying for it with debt. It was unsustainable. And now we've seen this chickens come back to roost, bud. We've seen the bill come due, and now they're having to spin off these. They sold DirecTV. They're spinning off Time Warner. They're bringing in that cash, and now they're righting the ship. They're doing what they need to do to really lower that debt. They're going to get about $43 billion in cash from that spinoff of Time Warner. So that is going to dramatically reduce the debt. They're going to be focused on that 5G story and the telecom. I think it's a company that is very good in value territory right now. This is kind of the inflection point where it starts to they start to see that cash flow growth in the 5G segment in that market. And I like the dividend. Even after the cut, it's going to be cut pretty close to 50%. It's going to come down to like $1.11 per share, they said, which is still going to be about 4.5% to 5% dividend yield, which is huge for a large company like that. So it's still going to be a very good dividend yield. It's still going to be a very attractive value stock, and not going to make you rich, obviously, one of those very slow growth telecom stocks, but it is going to be stable and is going to be a good dividend yield for you. Okay. Well, we are heading on to an hour and a half into this. I thank everybody for being here. If I didn't get to your question, ask it in the comments below, and I'll try to get to it later on in the day when I'm at the gym and on the treadmill, And please just thank you for being a part of the community. Check out that technical analysis webinar that is totally free to sign up for. Going to give you those 3 stock signals for when to buy and when to sell stocks and that kind of thing. But again, thank you for being here, and I'll see you next time.